Hi everybody, it's Monday, December 1st, 2025. Our episode starts with our first headline, Reasons for Yields Rising Today. Financial Times is reporting today that global bonds slide after hawkish Bank of Japan comments, suggesting that the central bank's attitude on yields is that they're not high enough, and this was the reason for a global bond sell-off today. It may have contributed to that, in my view. But we also have a headline from CNBC discussing the fact that we're getting closer to a regime change at the Fed, with presumably a more dovish new Fed chair coming in. My take on it is that I have the same stance that I had on Friday. The cats were away all last week and the mice were playing as bond yields dropped in the 10-year Treasury note yield, as you can see here, from averaging around 4.1 down to 4.0 basically. And all that really happened today on Monday is we rose back into that range around 4.1, as I suggested in Friday's show would be a strong possibility. So the way I am interpreting this is that the pros feel more comfortable with the 10-year around 4.1 than they do at 4. It's not like this is breaking higher. We could go that way, but as far as today's candle goes, we rose 7 basis points to about 4.1%, back to the range that we've been in since the end of October. Second headline, I've been making a mistake on this show. The headline reads, No employment report before FOMC. I've been saying that December 5th, we were getting the October report, and December 9th, the November report. That was true until a few days before I left. It was around the 20th when this became no longer the case. We're no longer getting employment data until December 16th, for the October-November employment reports, which is 6 days after the FOMC. So now it makes sense to me why there is a 0% probability priced into the Fed funds futures of a 50 basis point cut. There's no data to perhaps, make that happen or steer it the other way. We're still at a 80% chance of a 25 basis point cut. So if anything changes, maybe it'll just be some tariff update. On to our community topics today. My question of the day for you guys is, what would it take for the U.S. to be fiscally responsible? Comment below. What would trigger people to insist that the federal government balance their book however it's done? Either by raising taxes enough to foot the bill, or cut spending, or some combination of two. I'm curious, what do you guys think would have to occur in order for the U.S. to become fiscally responsible? Or do you think that there is just no possible way on God's green earth that this will ever happen ever again? Let me hear your ideas. Comment below. Coming up, FOMC's on December 10th, like we already talked about. And also, no CPI, no October CPI, as we've discussed before, but we do get November's on the 18th. Thank you for liking, watching, subscribing, commenting, and supporting Robschild. On to the charts, starting with SPX S&P 500. The notable thing about today was that the opening and the closing was within 30 cents of each other. It is, I don't know if you can see it on the screen, this candle here, but it's there, that little green sideways line, essentially closing on this trend line that we have from the highs. I'll repeat, I am of the opinion that Friday's bullish move was mostly on the back of the cats being away and the mice playing, and today we're just right at that spot where the breakout occurred. Next, I want to talk about Bitcoin. The red candle here is Monday's candle. The only thing I can say about this chart right now is that the bulls do not look very strong at all. We were not even able to get back up to the $97,000 range, which represents this trend line, major trend line from the August of 2024 bottom to the April 11th bottom. We broke through, we confirmed, And then we got a big shadow to the downside, which said, okay, we're definitely going back up to retest this line. We even formed a little bull flag here, like we should just break out straight to it. It should have happened, and it didn't. I'm looking at today's red candle as a huge loss for the bulls in Bitcoin at the moment, and a win for the bears. And then also zooming out, it looks like we may be forming a larger bear flag in my view. Next up, crude oil. I bring it up because one of my favorite trendline traders is Gareth Soloway and his show on verified investing. If you don't know about him, check him out. His work is amazing. I can't not share the fact that he said on his main show that he went bullish here on last Tuesday, I think, when it hit this bottom line again in crude oil, and he's expecting it to break out higher because of a cup and handle. He seems very convinced of this, which makes me think, I mean, maybe he's right. He has a lot of experience watching a lot of charts. I understand tensions with Venezuela can put a bit of a squeeze on the price. I'm in the camp that, the whole reason for this pattern development, remember the end of October, this spike here, when we formed the right side of this cup, that was because of sanctions on Russia. And now that whole thing is dwindling down, I don't think we're headed higher in crude oil, but I'm really curious to see what happens next. We did kiss the top of these, wicks here today. And now that we're at the top here, are we going to fight here? Are we going to break through it? Are we actually going up in crude oil, or are we going back down? Are we going to break lower below, the low of October 20th, around $56 a barrel? My crystal ball says we're going down, but I guess we'll see. I mentioned on Friday's show, I said I wouldn't be surprised if gold got flushed straight back down. It did not today. We are actually sort of just consolidating at this level, 42.24. If this continues to look more bullish, maybe we could get a double top kind of situation. Also, a bullish looking chart in silver going higher today, reaching an intraday high of 58.85. I also want to mention that credit spreads are staying a bit below 3% right now between junk bonds and treasuries. Anything below 3% is fairly complacent. And the last thing I want to note that I think is important to wrap up today is the 10-year break-even inflation rate. The point is we are at 2.23. We're basically going flat here, as you can see at the end. Actually, that's weird. That was updated last for Friday. I think we should have gotten an update today. But, if we take a look at TIP divided by IEF, it's another way to see what TIPs are doing versus non-treasury protected securities. We rose a tiny bit today, but not really breaking out of this falling pattern. But my point here is that if Financial Times headline is correct, that global bonds are sliding because of the Japanese central bank being hawkish, saying, rates really should be higher. Well, that's sort of a sign that's saying, inflation, we're concerned with inflation being too high. And I always turn to what's going on with TIPS to see what the market is actually doing and reacting to this. And it's not like all of a sudden inflation expectations have, cracked or moved significantly higher or anything like that. And again, I'll repeat, I think the pros simply are taking the 10-year Treasury note yield back to where it was before the Thanksgiving break period. And stocks essentially collectively went flat today. And I think this is like just trying to get to a neutral zone, waiting for the next a big headline, whether it be tariffs or, what economic data is there to look forward to? I know we have tomorrow, it looks like, at least investing.com is saying we're getting job openings, the JOLTS job openings for September. That could rock things around. Tomorrow we have that at 10 a.m. And then we have another ADP non-farm employment change for November at 8:15. That's on Wednesday. And we could always have on Thursday an initial jobless claims that, could come out of left field. We haven't gotten one yet. All that time, while the federal government was shut down and we weren't getting these reports, I was kind of wondering if this thing was spiking. And there's no evidence of that yet, but this can spike at any time. And then Friday we have PCE. That's the Fed favorite way of gauging inflation. If we get crazy numbers there, it could push the Fed funds. Predict a different situation for FOMC on the 10th. Things are quiet. Too quiet. Maybe we'll get a tariff update tomorrow. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and see you next time. Robschild.